So what kind of bond is it? Maturity wise, what is it? The 2-year bond as far as ratings. Triple B plus. All right. So 2 years. So our risk-free rate is going to be 272. I think most of you got that. Our spread's going to be 85. I saw a lot of 85s in there. So our discount rate is going to be 272 plus 0.0085. That's going to equal 0.0357 or something. All right. What I didn't see from some of y'all was the effective yield. Y'all remember the effective yield? 1 plus 0.0357 divided by 2 raised to the second minus 1. So don't forget that little piece, but so 357 plus 1 plus 0.0357 divided by 2 raised to the second minus 1. So 3.6% essentially. All right. What's our cash flow? So the coupon 6%. What's our cash flow going to be? $30. So if we set this up, $3.6%. Coupon 6%. So there's a few ways to figure this out. One is you can use your calculators as a double check. So you can do minus present value. The rate is here. You don't do the effective yield here because it's going to do it for you. So you do that divided by 2. The number of periods is 4 because it's every 6 months. The payment is 30, and the future value is 1,000. Y'all remember that? So you can put that into your calculator. I saw 1046. Did someone actually get it? I thought one team had team 4. Where's team 4? All right, that looks pretty close. The other approach is my approach, $30 divided by 0.0357 divided by 2 plus $1,000 minus $30 divided by 0.057 divided by 2. All of that divided by 1 plus 0.3357 divided by 2 raised to the 4th. That's exactly what the calculator is doing. So that looks pretty promising, but what you have to do on the exam is time, cash flow, discount factor, and discounted cash flow. So you got to do that. So time is going to be 0.5, 1, 1.5, and 2. Cash flow is going to be 30, 30, 30, 1,030. That makes sense. I remember those. I think most of y'all did that. And then 1 divided by 1 plus the discount rate, time, and then our discount, and you have to lock in and then multiply across. So it looks like it's 1046.51. It looks like team 4 got it. There's some rounding. Looks like team 5. Where's team 5? Nolan, looks like y'all got it. Looks real close. Y'all got actually to the penny. I must have done an Excel. Oh, and team 6 too. All right, so we had 3 teams get it. That's good. What's that going to do to their rankings then? So team 3, so 4, 5, and 6 got it. So they may be moving up here. We'll see. All right, that's good. So we have another team competition on what is it? Thursday? All right. Double check. All right. So we've done the weighted average cost of capital. So you have that application to work on. What we're going to do here, which is your next application, which is a fairly straightforward one, although I'll try to clue y'all in where students make mistakes on the application. It's really referencing, and I know why it is, because the problem I give you, there's a couple numbers that are real similar, and some students reference the wrong cell by accident, and so when they create the second problem, they mess that up. But I want to do economic value added. It's a good concept. It's a pretty important one. There's another concept that's really similar. It's called residual income. The two are real similar. It depends on what school you go to. My graduate school, they did residual income. Economic value added is probably the more common of the two, but they're very similar concepts. When Bob Davis became CEO of UTSA, he was a huge EVA, economic value added CEO. He just loved it. If I were starting the firm, I would use EVA, definitely. So what we're doing with EVA is we're assessing how good of a job management's doing, which is pretty important. If you have a Bloomberg account, Bloomberg has an EVA function. You just find your company and type WACC, W-A-C-C, and it gives you a good indication of what EVA is. So WACC you just did, that's the cost of capital of the firm. So if you remember WACC is the return you need to make so that you cover your risk. So your investors make enough money. So if your WACC is 6%, if you make 6% or higher, then your investors should be happy. You're making them an adequate return. What we're going to compare the WACC to is the actual return the firm makes, which we call the return on invested capital, ROIC, return on invested capital. I should have written that out. Now, when you did the project, when you did the project, you had return on equity. Return on equity is return on shareholders' investment. This is stockholders only, all right? So return on equity is only your stockholders. Return on invested capital is stock and bondholders. So it's all of your investors. All right, so be real careful. We're going to compare ROIC, the WACC. Why? Because WACC is KD and KE. KD, remember, that's the bondholders' return. KE is the stockholders' return. So return on capital, invested capital, is both stock and bondholders. When you're doing ROE, you do that versus KE because it's only the stockholders. All right. So always important to know whether you're talking about bondholders and stockholders or just stockholders. So WACC you use for the entire firm, that's KD and KE, and you compare that versus return on invested capital, which is the return on the entire firm. ROE, you only compare that to cost of equity capital. All right. Very important. So when we look at economic value added, we're looking at how does the firm's return on all of their capital compare to their required return on all capital. And it's the best value measure for a firm. It's a pretty popular concept. So there's a you may have this debate in the class. I don't know which class you have it, but what is the top priority for management? And thanks to Milton Friedman back in the 60s and 70s, he argued that the number one goal of management is to maximize shareholder value. It's the stockholder, because the stockholders are the owner of the firms. So management works for them. It's their money. They should maximize the value for the firm. Now, you can get you may have heard some of the debates in the last few years that you can't just maximize stockholders, you got to do society and employees and workers. And how do you balance all of these? You can have that debate in your class. There's a really famous professor, Damodaran, or Damodaran. I listened to a podcast with him today, and he said his last name, and I don't say it like he says it, Damodaran or something. He argues you max shareholder value in order to max employee, customer, vendor, and society. He says they're one and the same. You maximize the value to the stockholder, you're doing all these other things. Now, he followed in a presentation, he followed a marketing person, and she said, your goal is to maximize the value to the customer. And he says, well, that's ridiculous. And why is that ridiculous? What would your customers want? You're going to HEB. How would HEB maximize for you? Give everything for free, right? That'd be great. What would happen to HEB if they gave everything away for free? They go out of business. What would maximize for the employees? Maybe they could pay $2,000 an hour. Would that make employees happy? What would happen to HEB if they paid $2,000 an hour? They go out of business. So you go through each one of these vendors. Hey, you know what? Overpay your vendors, pay them twice as much. Society, don't use any electricity, don't do any polluting whatsoever. Well, then you don't have a business. You can't run. So what Damodaran says is maximizing shareholder value actually maximizes all these others, because if you don't make your employees happy, they're all going to quit. So you think about Costco. Costco pays their employees better than Walmart. Why doesn't Costco go out of business? Well, because Costco's employee turnover is really, really low. They benefit on the other side. Walmart's customers, Costco's customers love them because their prices are really low. But Tiffany does well as well. Why? Everybody has their own approach. So that's his argument. I can see that argument. He's arguing that it's not a choice. You don't have to pick between these. You can maximize all of them at once. My first big presentation I made at UTSA, my CFO said, I want you to prove that you can have good returns and have good product value at the same time. You don't have to choose between having good return on equity and then having really, you have to have horrible products. You have to rip off the customer. So you want to show that it's possible. And so I went out and I looked for some of the best companies out there, and sure enough, they had the best returns and they had the best customer products. So it's possible to do both. So that's his argument. If you don't buy this argument, it's fine. I've seen all the articles out there. I'm going to tell you that's the approach most finance professors are going to take. Maximize shareholder value, and everything else will work. All these other stakeholders, they'll benefit if you maximize stockholders. Huh? Well, ultimately, you've got a firm that's just polluting society. That might save them money, and their customers may like it, but government's going to shut down on them. People in the neighborhood are going to complain. Is it possible? You take a firm like, say, Dow Chemicals, a firm that's had a lot of really bad press on some of it harms the firm tremendously. So ultimately, people complain, legislatures do things. So it's ultimately as government's going to make that decision. If you take economics, they have something called excess burdens. Have y'all studied that yet? So what's an excess burden? It's a firm that pollutes the society, but they don't pay for that pollution. So if you're producing excess burdens, who should pay for that? Well, you want the firm to pay for it. You don't want them to have, you can compare that to free riders. That's when you get to share in something that's good and you don't have to pay for it. So what government should do is make sure people who have excess burdens, they're paying for that excess burden. If they're polluting, they should pay for that pollution so it gets cleaned up. If they have something everybody benefits from, then people should pay them for that. Otherwise, what happens with free riders? You overuse that good and it becomes overused and gets worn out. So who decides that? Ultimately, we do as voters and legislatures, and even firms pay for that. There's people get mad when firms pollute the environment and they boycott them and those kind of things. But yeah, that's Demodaren, whatever his name is. He was talking about governance and how do you measure governance, ESG. And he says all the things we're using in our governance scores, he says, are worthless because they don't tell you what's really important on governance. What's important on governance is when the board says, no, management, you're not going to do that. He says good governance is when the board actually steps in and doesn't rubber stamp everything. That doesn't have anything to do with the makeup of the board. It has to do with whether that board has any teeth or not. That's his argument for good governance. And that's not what's measured because that's hard to measure. But he was talking to one CEO. He says, hey, my board's voted 100% on everything we propose. And he says, well, that sounds like a rubber stamp. That doesn't sound like a board. So yeah, I mean, that's the question, is how do you measure these things and how do you actually get management to do what's in the best interest of stockholders and for society. So there are other stakeholders. How do you manage all this and balance all of this? And those are the debates we have constantly in society. So how do you measure this? Well, GAAP earnings is one way to do it, but what economic value added says is GAAP earnings doesn't capture everything. First of all, GAAP earnings can be manipulated. GAAP earnings ignores risk and cost of capital requirements. So what economic value added is trying to do is take GAAP earnings and adjust it to bring in all these other economic things. We want to measure management on what's truly important. So economic value added, many firms are using EVA to compensate management. Now the problem is once you define the rules, management starts trying to manipulate the rules. That's what Demodaren was saying about ESG on the G part of ESG. Once management knows how G is measured, they start artificially getting that number higher, even though that doesn't improve governance at all. So it's the same thing with EVA. Once you know how it's measured, then you can artificially try to improve it. It's pretty hilarious. There's a famous measurement out there. It's called ease of doing business. I think it's the World Bank that does it. I think they stopped doing it. And the reason they stopped doing it is Russia started moving up the list real fast. And why did Russia start moving up the list? Was it because they're making it easier to do business in Russia? No. They looked at the formula and they figured out how to manipulate formula so they could move up the list. And so you can see right now, I don't know where Russia is on the list right now, but you can see where everybody is. Looks like they've moved back down. I don't know where they are. But who's in last place? Is Venezuela or somebody? There's Venezuela. Eritrea, Somalia, Liechtenstein doesn't even get a score. So Somalia is in last place. Obviously, these are countries, facing civil wars and famines and all those kind of things that are not usually good for business. New Zealand's in first, United States in sixth. Singapore, Hong Kong, you've seen some Asian and Scandinavian countries, New Zealand, well, I guess Asia, and then Denmark. What I think is interesting about this is what they actually put in the list. How easy is it to start a business? How easy to get a construction permit? And then you could ask, where does the US do well? Where does it do poorly? So starting a business, we're pretty low. New Zealand is pretty high. But the problem with that, it really doesn't have much to do with this, but the problem with that is people are collecting data. Does that data really, really, truly reflect what's going on in that country, or can it be artificially adjusted? So what management has to figure out is, or really as board, is there a way we can measure what management's doing without them manipulating these numbers to get them higher? So there's a lot of ways to measure it. We're going to keep it pretty simple in here. But essentially what we're trying to do is add back those non-economic things into the measurements. Let me just give you a real simple example so you can see how this works. Emmanuel, if you go to USA, I don't think they do EVA anymore, but you should ask them because their EVA spreadsheet is as impressive as their WAC spreadsheet. It goes on for many, many, many pages. So let's just give an example. Let's say you start a new business and you invest $100,000 of your money and you make $62,000. Your expenses are $61,500. And I should have taken this out, sorry. So your profit's 500. Now you're thinking, I can't live off of $500, but this expense might include a salary you paid yourself. So you might be okay. All right. So you may not want to quit your job to make $500, but if you pay yourself $50,000 and it's your own business, and you're going to grow up, maybe you're okay with that. But that's your accounting profit. Did you have an economic profit? So the goal is what's in the revenue or in the expense that's not really economic. So we want to adjust this so that we go from an accounting profit to an economic profit. So a good example might be depreciation. Depreciation, that's not really economic number. That's just a random number that we expense something over time. So let's add depreciation back. And let's call that our economic profit. And that really is the only adjustment we're going to make. Now, USA, we debated this. What are we going to add back to our earnings? And I can't remember what they are. There was many, many, many adjustments. But let's add back depreciation. So for your example, for the exam and for your applications, depreciation is the only thing we're going to add out. The other thing we have is cost of capital. Here, our expenses, there's no cost of capital on that because we didn't borrow any money. So there's no interest expense in there. All right. So our only cost of capital is what we need to make. I invested $100,000 of my money. What was the cost of capital for that? So here's a few things we could say. I could have taken that money instead of starting a business. I could have bought a 1-year treasury and made 1.2%. I could have made $1,200. So I would have been better off keeping my job where I was. And instead of starting this business, I could have just invested $100,000 in treasuries. I would have made $1,200. Instead, I only made $1,100. So I didn't do very well. And the problem with that is the treasury is pretty low risk. I realize they're having debt ceiling debates right now, but treasuries are very low risk securities. How low risk is starting your own business? That's pretty high risk, right? So you shouldn't compare yourself to treasuries because treasuries are low risk, your business is high risk. So not only did you underperform treasuries, but you underperformed something that's very low risk. You could have put your money in the stock market and made 28% or $28,000. If you'd known that, you might have waited a year to start your business, put the $100,000 in the stock market, then you'd have $128,000 to start your business with, but you didn't know that. But the problem with the stock market is it's pretty risky too. It could have been down 40%. Who knows? So it gets a little tricky. So we're trying to figure out the opportunity cost. What could we have done with that $100,000 besides starting the business? And that opportunity cost needs to be risk adjusted. We can't compare to treasuries because treasuries are low risk. The stock market might be comparable, that may be one to compare with, but sometimes the stock market's up 30%, sometimes it's down 30%. So what are we going to do? Well, real simple. Opportunity cost is going to be our weighted average cost of capital, the number we already calculated. We need to make that opportunity a weighted average cost of capital. All right, so let's do a more specific example so you can see how we bring all this together. Do any of y'all want to start your own businesses? Is that the dream for any of y'all? Do you? Do you know what it is, or you like anything? Consulting, huh? Oh, okay. In real estate, I mean, residential or commercial real estate? Oh, no. I don't. Oh. Oh, okay. Oh, I see. Meal prep. Oh, that's interesting. You can actually compete with HelloFresh? Oh, okay. I see. All right, interesting. Yes. All right. So yeah, I hope some of y'all become billionaires. That'd be interesting. We'll have a building named after you. Yeah, so if you're gonna do it, this is a really good way to thinking about it. So let's say in this case, you put 40,000 into your own business. And you think that's about as risky as investing in the stock market. That's probably not true. It's probably a lot more risky. And you think on average, the stock market will make 8%. So you're going to say, you know what? I need to make 8% of my money. Otherwise, I'll just invest it in the stock market. And you borrow 40,000 from the bank and they charge you for some reason 5%. They should probably charge you a lot more than that. And so your capital employed, have you heard that term? That's the same as invested capital. You're in capital employed. And it sounds kind of strange. Your capital is out there working for you, but that's kind of the idea, right? Your capital gets employed. And so you have $80,000 of money that's employed. 40,000 is your money, 40,000 is the bank money, but you got to pay the bank back. And let's say you make $70,000 in revenue. Your expenses are $65,000. That includes $440 in depreciation. And your interest expense is the $40,000 you borrow from the bank times 5% or $2,000. So your accounting profit is $3,000. Now I'm ignoring taxes in here, and we're going to ignore taxes. So we're going to add two things back. We're going to add back depreciation because that's a non-economic expense. We're also going to add back interest expense because we want to look at our profit before cost of capital. So any cost of capital on our net income, we want to add that back. So that gives us $54.40. All right, our $3,000 accounting profit plus depreciation plus our interest expense, we add that back. Our economic profit is $54.40. We want to compare that to our cost of capital. Our cost of capital is the $2,000 of interest expense. Our equity, we invested $40,000 of our money. We need to make 8%. So we need to make $3,200. We could use CAPM to come up with that if we wanted to. You could have artificially kind of done that. It's really, I don't want to confuse y'all. This is exactly the same thing we did with WACC, weighted average cost of capital. It's the exact same thing. I'm just using slightly different jargon here, but it really is the same. So our cost of capital is $5,200 in dollars. So our economic value added is $54.40 minus $5,200. We made $240. And anything greater than zero is good. That 240 means we added value to the firm. All right. Now we can convert this into percents. So our economic profit, we made $54.40 divided by the 80,000 we invested. That gives us a return on invested capital of 6.8%. That return on invested capital is just your profit over your debt plus equity. Our cost of capital is $5,200 divided by 80,000, 6.5%. Our economic value added is $240. Our economic value added spread is our return on capital minus our cost of capital, or 0.3%. Now at USAA, Bob Davis, his goal, I think, was 2%. He wanted us to make a 2% EVA. I don't know where the 2% came from. So if our cost of capital was 5%, we need to make a 7% return on invested capital. Now, on the Excel application where students make the mistake is not referencing the right line here. This 2,000 here should be exact same number here. So make sure when you add the interest expense back, you pull the right number and that it's the same number here. Some students, I think one of the problems, we'll have to look at the problems. One of the problems, some of the numbers are real close to each other and they just reference the wrong line and they get thrown off. So be real careful, double check on that you get that correct. We'll look at a problem here, the same one you have, but all right, so it's a really good process. What you have to decide is what you're going to add back. And then the cost of capital, reason this is so complicated at USA is the same reason their cost of capital was so complicated, because they have so many sources of capital. The life insurance company has annuities, the bank has CDs and savings account. I mean, it's just really complex. So this is the complex part. I don't remember what adjustment USA made. I know they added depreciation back, but they may have made a few other adjustments to get that number. I just don't remember what they are. All right, let's look at another example. It's the same one that you're going to get for the example on the YouTube. I just got to find it here. I should have loaded it. So I give you revenue, and this is going to look real similar to the exam question. I give you revenue, I get expense, and expense has a footnote. It includes $400,000 in depreciation and $1 million that she paid to herself. What did I do with the $1 million she paid to herself when we did EVA? Y'all remember? Huh? It was in expenses. What did I do to adjust it? Let's say this includes $60,000 she paid to herself. What did I do with that? Y'all see it anywhere? I didn't do anything with it, right? That's bogus information to throw you off. Okay. The fact that she's paying herself salary is perfectly fine. Why? Because if she wasn't working for this business, she'd be working somewhere else and could make the $1 million. So that's a perfectly legitimate economic cost that she should count as a cost. I mean, should she say, hey, you know what, I'm going to add the $1 million back because, hey, I should work for free? Does that make sense? Should she work for free? She could work somewhere else, right? So she should count the salary she pays herself as a legitimate business expense. That's one thing on the franchises. Those who are doing franchises, I think you could actually, if you think you're going to be spending 20 hours a week of your own time on this franchise, that you could say, hey, my time's worth $100 an hour. I'm going to put that in as a legitimate expense on my project. You could actually do that on your project and count it because your time's valuable. So we completely ignore that, but we are going to add the 400,000 back. So in here, we're going to calculate the economic value added in both dollars and percents. They invest $5 million of their own money. She requires a 22% return on her own money. She borrows $10 million from the bank at 10%. These are more realistic numbers here. Banks are going to charge you quite a bit of money to start your own business. You don't have much collateral, right? If you go out of business, what are you going to give them? Well, I've got $50 in inventory, right? Emmanuel, if you start doing your own meals, what do you have? You can give them produce that's probably spoiled by the time you go out of business. You won't go out of business, but your competitor, you don't have much collateral. So they're going to say, hey, we're going to have to charge you a lot of money because, this is dangerous. Most new businesses struggle. So 10% is a pretty high number. And then it's riskier to investing in the stock market. So yeah, if you're starting your own business, your cost of capital can be pretty significant. You really need a high return because this is a risky thing to do. I don't know if Emmanuel's going to pay himself $1 million in his first year. So I don't know what she's doing. Maybe I started my own consulting business, so you can start consulting businesses. So let's set this up. So all you have to do is just set it up just like it's shown here. 24 million. I'm gonna round it a little bit. Our net income is 2 million. And then we have interest expense. This is our EBIT, but our T is 0, so it's still EBIT, but our ET is 0. Our interest expense is what? $10 million from the bank times 10%, or $1 million, for our net income. Our net income is 2 million minus 1 million. All right, because can y'all see now why people mess up the second problem? I got a lot of really similar numbers there. So be careful. All right. All right, so we're going to add back what? What's the only adjustment we're going to make to get back to EVA? Depreciation, I add that back. That's in this $22 million. We're going to add it back. So there's our EVA. And then we need to do our cost of capital. Cost of capital is equity. It's debt, or you can do debt. You can do it whatever order, it doesn't matter. So our equity is going to be what? Well, how much of her money did she put in there? $5 million, and she needs 22%. That's just given. So if you want to, so that you're careful, I don't remember what I did in the video, but if you want to, you can put capital employed off to the side. So you make sure you cover it. So we have equity is 5 million and debt is 10 million. Your total capital is the sum of those two. So if you want to put that off separately, that just makes it safer. So when you calculate these, and here you can put the cost over to the side if you want to as well. 22% and 10%. That way you just make sure you have, when you copy it for the second problem, you have it all set up. So what's my cost of capital for equity? Sorry, my left finger is numb because I have some problem with my left hand, so I cannot type. You're like that all the time. What do you mean? Yeah, it's especially bad right now. So our cost of equity capital is 1.1 million. Our debt is 1 million. But make sure this line, make sure that and that are exactly the same. So our total cost of capital is that. Oh, I made a mistake. Sorry, what did I make a mistake? I left out one thing. I did it on purpose to see if you are paying attention. I left out one thing. What did I leave out? You add back depreciation. What else do you add back for EVA? Interest expense, right? So make sure you notice how interest expense is in there 3 times. Make sure you have it right every single time. All right, it's got to be the same number. So that's the biggest thing I noticed on problem 2 and on the exam, is because my example problem, the numbers are so similar, students get a little mixed up. So make sure the interest expense is the interest expense is the interest expense. Yeah, very good. So add back the interest expense. And so what is my EVA? The EVA is going to be, oh, and that's not EVA. Sorry, this is economic profit. I'm just testing to see if you're paying attention. So that's my economic profit. My EVA is my economic profit minus my cost capital. My EVA, my return on invested capital, is going to be my economic profit divided by my capital employed. So my 2,400 divided by my 1,500, 15,000, 15 million. And my WACC is my cost of capital divided by capital employed, by 2,100 divided by 15 or 22.1 million. And my EVA spread then is the 16 minus the 14 is 2%. All right, so I want EVA in dollars and in percents. Now USAA, we only showed it as a percent. We showed this number, we showed this number, and we showed this number. We never did it in dollars. So dollars is actually not that common. Now, if you go on the Bloomberg machine, it's called the WACC function. I would, especially for finance major or accounting major, I would I know you'll have to do a capstone class. That whack function is really quite powerful. It has a lot of stuff in it. It shows the KE, it shows the KD, it shows the weight of debt, it shows the weight of equity, it shows the tax rate, it shows the whack, it shows return on invested capital. It shows all of that stuff, which is really, really cool. It's all there. It's Bloomberg's numbers, so you may not agree with them, especially the KE, but the KD is pretty powerful. So they show all of this. Not only that, but they'll graph. You can graph WACC and return on invested capital against each other over time. You can do the EVA. You can do the EVA spread. They do all of those things. So it's a good chance you'll have a project in one of your classes where you're going to be doing exactly this, and Bloomberg will do a lot of this for you. I've had some students in their capstone class just go to Bloomberg and steal all this data and just use it in their class. And you know, they probably should tell the teacher they're doing that, but yeah, they come up with all this stuff. The reason Bloomberg is really powerful is they have the debt for all these firms, so it's like a really fast way to get the number. You can go pull all the pieces of debt from their annual report or from Bloomberg, but it's a lot of work. Bloomberg does it all for you, all in one number. You don't have to go look for all that stuff. So it's really kind of cool. So economic value added is a powerful tool. It's been around, I forget how many years. It's been maybe 20, 30 years. It's something that started essentially while when I started my career. I forget who invented it. There he is. Independently, William Simons, a German businessman. So it's been around. Yeah, I remember from the 80s, but I don't, that may not be the right one. But anyway, it's used by many companies, but not all companies. So it'd be interesting. You should ask your, you know, in an interview, do you use economic value added? So there's two firms here in town I know have used it, UTSA and oh, I forgot the name of the firm. Rackspace. I don't know about Valero. I don't think Valero uses it. I don't think HEB uses it. But Rackspace, their CFO came and spoke at UTSA, and this is what he said, and I thought it was really, really interesting. First, he said EVA is always wrong, so don't focus on it. So what did he mean? What he was saying is all these adjustments we're going to make are pretty subjective and pretty difficult to come up with. So he was saying EVA itself is wrong. He said the key is EVA over time. How does it change? He said that's what you focus in on. You come up with a formula, you agree with it, and then you watch it over time. So he said, don't get too worked up on should it be, you know, X% or whatever, you know, just pick a number and go with it. And this is absolutely true. I wish I could show you the numbers, but I'll give you an example. But this is true. If you want to be the greatest stock investor in the world, then do this, because this is the number one thing that predicts how stock will do. If you want to see why a stock went up in value, look at its EVA, and that will tell you. So how can I show you that? Oh, boy, I'm going to sue them after I sue Zoom. All right, so let's look at this. I don't go back quite that far, but this is Home Depot. I want to do a comparison with Lowe's. And I want to go back. Let's go back to 2010. So You notice Home Depot has outperformed stock wise, especially if you go, it got real impressive right until here. So what happened back in here? What did Home Depot do? Now, if you look at the history of this, I just started my job as head of equities at USAA, and they hired this famous guy. I forget who it was, but they're going to have this famous guy do stuff with us. So they bring this guy in. He's pretty arrogant guy, and I'm just new in my job. And so he's asking for investment ideas, and my investment idea was Home Depot. And he looked at me, "You idiot, that's the stupidest stock." I'm like, "Well, great, I'm in front of my new boss," and he's calling me an idiot. He was really rude. But my argument for Home Depot is it was doing so horribly at the time, and it had new management. And my sense was this is a turnaround situation. They're getting beat by Lowe's left and right, but they lost their kind of their advantages, and now they got a new CEO. And that was my argument. This is a turnaround situation. I wish I could talk to the guy, 10 years later, because it turned out really well. But how could you could tell? And if you were to watch Home Depot's stock outperformance versus Lowe, and if you compare their EVA, the Lowe's EVA, you would notice Home Depot's EVA shot up like that, and Lowe's just stayed flat. And that's true for a lot of companies. I could probably show you 50 different companies. Home Depot I like to show you just because I'm so upset with the guy for yelling at me. But Home Depot was perfect, and it just comes out in the numbers. Now the problem is, it's true. If you could do that, you would beat every other stock investor out there. The problem is figuring out what company's EVA is suddenly going to shoot up, and that's as hard of a forecast as anything else. That's what you're looking for. How would Bed Bath & Beyond's EVA look right now? Pretty pathetic, right? It's messed up, horrible, wouldn't look good at all. These firms, economic value added, and I'm using Bloomberg's definition, which is a fairly crude definition, but even then it works incredibly well. You look at firms over time, the ones whose EVA is doing better, their stock price is going to do the best. It's just, it's pretty predictable, pretty obvious. All right, so that's a good way to think about your firm. Why is that a good way to think about your firm? Well, first of all, you acknowledge that your money has an opportunity cost. You're investing your money into your business. That's not free. You need a return on your money. Secondly, it reflects that you're not stuck with GAAP. You can come up with your own measurements if you want to. There's no one that says you have to follow GAAP accounting. So that's kind of nice. It also is going to tell you whether or not you're doing well. And you want to know that. A lot of time, I don't want to pick on your accounting majors, but a lot of time accounting majors think a firm's doing well because they have a profit. But if you have a profit, but it's not a good enough profit to cover your risk and your cost of capital, you're not doing well. So accounting especially ignores this equity cost of capital. Accounting often thinks that this cost of capital and equity side is just free. Now they have the interest expense in their numbers. That's true. This 3,000 is less interest expense, but it completely ignores the cost of capital for the equity holders, and EVA brings that in explicitly. So I think it's a great way to look at a firm. So I had a student in my executive MBA class. He ran his own business. So his business was a healthy vending business. He wanted to put vending machines on campus that had healthy food. Do we have anything like that at UTSA? Do y'all want healthy vending? I've seen the vending machines here. They're horrible. It's like if I ate that, I'd be dead in a week. It's just terrible. Like Fritos. Have you ever looked at the back of a Fritos package? You probably don't want to look at it, right? It's just horrible food. So that was his thing. Healthy vending. USA had a few healthy vending things. So we ran an EVA on his business. He wanted to know am I wasting my time doing this business? We ran it, and it was a very high EVA. And it gave him great confidence. It's okay, you got a business that makes a lot of sense. You just got to scale it now. You got to get some customers. But that was good for him to know is, okay, I'm doing well in this business. I don't want to start expanding it until I know it's actually a good business. And he knew it was a good business, so he could go out, call schools, businesses, and say, hey, I got these healthy vending machines. He also does delivery. I haven't used this delivery yet. I don't know what happened if I had a class where they delivered healthy snacks. Y'all probably be like, yeah, we don't want that stuff. Y'all are young. Y'all can handle it. Maybe old people would like a healthy vending delivery. But yeah, he gave him great confidence. I don't know how his business is doing now. And last time I saw it looked pretty good. I forget the name of it. But that sounds like a good business. You know, people are worried about their health and they want these alternatives. Another business is the Damodaran guy I was just talking about. He's from India, so he went back home. He goes back to India and visits family, and he has some family that own a business, and they asked him to do an EVA analysis, and he told them, "Your core business is great, but you keep buying other businesses, and the other businesses you're buying are horrible. You need to get rid of them. They have negative EVA. You keep buying businesses with negative EVA. If you would just get rid of all that and do what you do well." And they say, yeah, but they got profit. They have positive profits. Yeah. They're making $30 million and they need to be making $50 million for you to cover your cost of capital. You're throwing your value away. You're destroying value. So he does it, the same thing. In fact, there was a survey done many years ago, but they asked stock investors, what's the most important thing you look at in a firm? And the number one answer was EVA. So it's an important concept. It's a good one to know. But I don't know who uses it. I'd be curious to see. I'm not even sure, you know, Emmanuel, if you find out USA is using it, email me, let me know. Bob Davis did, but then when Joe Robles came in, I don't know if he used it. I'm pretty sure Stuart didn't use it, but I don't know about Wayne. All right, that's EVA. All right, so where are we going to go from here? All right, there's one essay question on the second exam. And the past 2 years, the students have done horribly. Now, y'all are smarter than my previous 2 classes. I don't know if that's true or not, but I'm just going to say that. So hopefully y'all will do better. I'm going to try to figure out what I'm doing wrong to make y'all do so badly on this essay, because it's an extremely important essay that you really need to understand. If you're accounting or finance major, you absolutely need to understand an extremely important essay. If you're cybersecurity, then, you know, learn it anyway. So I'm going to try my best. The problem is I keep trying, and when I keep trying, what I do is I type another answer into the notes. Now you got like 3 answers. Now you got 4 answers. So I'm just making it more complicated. So I'm going to try my best. But if you want to maybe get your mind ready for it, you can go out and read some stuff just on your own. And what it's called is optimal capital structure is the topic. And all kinds of things. Look what's right underneath it. WACC. So what is optimal capital structure? It's also associated with Miller and Modigliani. It's the Miller-Modigliani theorem. We're going to look at that. So it's a theory. When you look at images, you'll see images I'm going to give you. You're going to see images like that. You're going to see images like that. I think this one's actually in the class notes. So what the exam does is I give you one of these graphs without any labels, and you have to label it and explain it. All right, so that's what we're after. The labeling, most students don't have any problem with. Now, some of the graphs, it goes up, and up is better. Some of the graphs, it comes down, and down is better. So you have to know that. If higher is better, then I have value of the firm on the axis. If lower is better, I have cost of capital on the axis. All right, so that's what we're going to figure out is the optimal value of the firm is when their weighted average cost of capital is at its lowest point. All right, if you want to maximize the value of the firm, you minimize WACC. So the question Miller-Modigliani asked is there an optimal capital structure such that WACC is minimized? And their first answer was no, it doesn't matter. And their second answer was yes, it does matter. Okay, which answer is correct? And the answer is yes, they're both correct. Okay, so that's what we're after, is to understand that. But if you want to read some of this, there are maybe Investopedia. That might help you, you know, the kind of, boy, I didn't spell Investopedia correctly. But if you give yourself a chance to read it from somebody, I'm not talking reading 20 pages. You can probably in a few paragraphs understand what we're after, but that's what we're trying to focus on here. First thing I would do is get the beta. It's actually two different questions. So you have one question where you have to come up with a WAC, which includes getting the KE, and that's part of that question. And then you use that KE for the valuation. So this is really two questions on the exam. But to get the beta, you start off with first, what kind of company is this? Does this sound more cyclical or more defensive? More cyclical. It's a B2B. Y'all know what B2B means? Business to business and cloud security. You might say, well, cloud security, you got to have that all the time, no matter what. But still, if firms are struggling, they're going to cut back on some of that. Sounds more cyclical. So beta above 1, maybe not dramatically above, but because it's a business that's extremely important. Op leverage. Well, heavy salaried, but their margin standard deviation is above average. So it's going to push beta slightly higher, not dramatically. It's not way off. Financial leverage, it's below average, right? They were ranked 34th, 30% debt to equity, below average debt to equity, limiting beta, moving back closer to 1. And then what did history suggest? Around 1.25 median. Tech companies, they tend to be in that 1 to 1.5. It kind of somewhat depends on the firm, but 1 to 1.5. I don't know what y'all use, but I'm going to use beta 1.25. The median's not a horrible thing to use. They've been below that here recently, but that's because they're not a bank and they're not a energy company. So what did y'all end up using? 1.2 would be reasonable. 1.1, a little bit lower. He went more with the last part. 1.1, yeah, you're a little bit lower than mine. 1.25, and then 1.1. Yeah, y'all are a little bit lower. You can, if you say, wow, they've been much lower here recently, you want to emphasize that. That's perfectly fine. Yeah, 1.3. They were real high back here. They've been low here. It's a subjective. I actually think these first three are more important than the history. It's what you really believe about the firm. And so the KE is going to be the risk-free rate, which is 2.9. I think most of y'all got that, plus the beta. I think one team did plus. It's not plus, it's times the market risk premium. Market risk premium is 0.049. So that'll give you a discount rate. Your discount rates are generally going to be in the 5 to 10% range in this particular environment. So if you get a discount rate of like 3%, there's probably something wrong with your calculation. If you get a discount rate of 14%, probably it's going to be, and it's going to be in a pretty close range of that. 0.029 plus 1.25 times 0.049 gives us 9.025 on mine. That may not be yours, so you're going to get slightly different answers. 9.025. And I recommend you never use percents. So once you get into the exam, put everything in decimals, forget percents. Some students get mixed up with percents and and do 90% instead of 9%. And then you just plug numbers into the formulas. So the dividend discount model, you have dividend 0, which is 3.27 times long-term growth, run plus long-term growth, which is 5%, divided by 0.09025 minus 5%. Right, I think most of y'all had something like that. The H model, it's the same thing again. But we're going to add 3.27 times, what's my H in this case? 5, because we expect this over 10 years. So that 10 years is important there. Times, and what's my short-term growth? 15 minus 0.05. So there's my H, and then my cap earnings. We have earnings per share of 5.44 times 1 plus inflation, 0.025, divided by 0.9025 minus 0.025. So I'm going to obviously get different answers than you because your betas were all different than mine. Let's try it. Let's see, 3.27 times 1.05 divided by 0.09025 minus 0.05 gives me 85 bucks. That's close to what some of y'all had. H model, same thing again, but we add 3.27 times 5 times 0.15 minus 0.05. Now, you can check this, all right? On the exam, you can check this because we notice that the difference is $40. Where did that difference come from? Well, the difference, you just take out the first part of the equation and it should be the same difference. So you can quickly check your answers and make sure, all right? And then the last one, we're going to use earnings per share, 5.44 plus 1.025. Divided by that minus 0.015, you get 85.46 if I did it all right. So those are the values I got. I don't know what y'all got. So one team, let's see, I'm going to substitute. His discount rate was 8.29, so I'm going to discount his discount rate and see if I get his numbers. He got 104.36. That looks good. He got 154. So yeah, Andrew, if you got the beta correct, let's see, 0.029 plus 1.1 times 0.049. All right, so there's one team that got full credit. So we'll see. Any other team think y'all got full credit? I can tell a couple of teams are pretty sure they didn't because they left a lot of stuff blank. So Andrew, what team number are you? Team 2. Team 2. What happens if team 2 gets 100%? Team 2's in 3rd place right now. No, team 2 is in 5th place. All right, so maybe team 2 will move up. Andrew, we'll see. How did team 6 do? Who's team 6? Y'all, did y'all get it right? Us? Okay. It's real close between team 6 and where's team 3? Did y'all get it right? Yeah, it's real close between 2 and 6, but we'll see. I mean, between 3 and 6, but team 2 might be moving up. Yeah, it's Oh, from Tuesday, it's in there. Yeah. All right. All right. Leslie. All right. We'll see. If it was really bad, we might try it again. Or see, I might just give you the WAC question as a team exercise so you can practice that beta again. All right, so let's talk capital structure. This is the only really major essay question on the second exam. So this is actually a really important concept. My first boss's boss in finance, he was a PhD in economics. He had a degree in English. Really intimidating guy. Scared me to death. Very hyper. He used to walk around with a pot of coffee in his hand, and he was just on caffeine all day long. Intense guy. Great boss, because I learned you want a boss that scares you to death. That's what you want. Doesn't scare you to death because they're mean. They scare you to death because they know so much. And this guy just knew so much. But this is one thing he used to say. And I said, wow, this is so really critical. There's two ways to increase the value of the firm. You increase free cash flow, or you reduce the WACC. Your CBA project is focused on the first one, is that getting that cash flow, higher cash flow gives you more value. So should you do the project, we're not really focusing on the WACC on that, but right now we're going to focus on the WACC. How can you reduce the cost of capital of the firm? And we're going to focus on this first approach, which is, can we change the mix between debt and equity and get a lower WACC? All right, that's what we're going to focus in on. The second approach is you just reduce the firm's beta somehow. How do you do that? Well, you find a way to reduce their fixed costs, or you find a way you get into less risky cyclical businesses, those type of things. Now, I don't know, when Valero sold off Cornerstone store, there's a good chance that Cornerstone store was a higher beta business than Valero, and that would have reduced their WACC. There are some people that say Valero sold off Cornerstone entirely reduced their cost of capital. So there are firms that might do that entirely. So can we do that? So before we do that, let's talk about where firms get their capital. You can reduce your cost of capital. So how much capital do they need, and how should that be allocated? How do you get it from debt versus equity? How much fund do you need? So if you're starting a new business, I essentially showed you this in this file I created for y'all. Any of y'all doing franchises, you'll see this file. So the franchise CBA, when you're doing a franchise, you essentially do a cash flow statement, and you figure out how much cash are you out. And in the first few years, you may be out cash, but you're essentially doing a cash flow. You're doing everything on a cash basis. And what you're going to have to borrow or put equity in is what you're short. So you have an initial investment of $550,000. That's the cash shortage you're going to make up, and you still have a cash shortage the second year and the third year. So you may have to borrow, $700,000, or put your money in, part of the other money in. Eventually you start getting cash back that you can start paying down that debt. So essentially what you do is you just forecast out your cash flow statement, and those negative cash flows, that's where you have to borrow money. That's your funding source. You want to try to minimize that as much as you can, but sometimes you don't have a whole lot of choice. So your funding needs are, you're changing cash, your working capital, any fixed assets you got to purchase. Your external funding needs are those funding needs that you need because your cash flow is inadequate. Where does that funding come from? So what is a capital market? As we're talking about capital, what is capital? That's debt and equity. What are capital markets? Those are markets that provide debt and equity. Financial services, also known as financial intermediaries, those are the main places capital markets are. That's the reason they're called financial intermediaries. They're between the providers of capital and the users of capital. We all know about banks. They're struggling right now. What kind of banks are there? There's money center banks. What's a good money center bank? Anybody know one? What's the biggest bank in the United States? JP Morgan Chase. Fleming, whatever, there's like 20 names. Has some money center bank. Regional banks, what's a good regional banks? Have y'all heard of PNC Bank? That would be a regional bank. Frost Bank might be a regional bank. Investment banks, we used to have investment banks, we don't anymore, but Goldman Sachs, Morgan Stanley, Merrill Lynch, those type, they've now converted to regular banks. Community banks, Broadway Bank would be a community bank. Credit unions, what's the difference between a credit union and a bank? What do credit unions have that no one else, that banks don't have, that makes banks really mad? Anybody know? Did y'all know credit unions are tax-free? They pay no income tax. The banks have been lobbying against that. Credit unions are owned by their customers. Huh? Yeah. Randolph Brooks, Security Services, those are credit unions. They're owned by the customers. They're tax-free. There was some push a few years ago, banks telling Congress, you got to tax these guys. It's not fair that they don't pay tax and we do. But they are owned by their customers. I was on the board of a credit union at UTSA. They're a little bit different entities. Savings banks essentially died during the savings and loan crisis back in the late 80s, but UTSA is a savings bank. So UTSA is one of those savings banks that survived. A savings bank is, I don't know how distinctive they are versus the others, but there are a lot of banks. Insurance companies, there's life, PNC, and then health, which is part of the life side. I teach a life insurance class, and I teach a property and casualty insurance class. I don't know if any of you are going to take my life class this next semester. It's got one really gruesome paper. We write a paper on healthcare reform. So if you want to get into healthcare reform, we go into it in detail. I hate the industry. I think it's a horrible industry. I think it rips off its customers quite horribly. So if you want to get in that industry and debate pharmaceuticals and hospitals and how they overcharge and do all kind of things and take that class, it's a gruesome paper. I had one student take that class. She wrote a really good paper. And then she was at a hotel where they were having a healthcare conference, and she caught some famous guy in the elevator, and she had this long debate with him on healthcare. She was so glad she had my class because she's like, yeah, I was like toe to toe with this guy. He couldn't handle my debates. And then investment companies, there's a lot of them. UTSA sold off their investment company, Victory Capital. The largest investment company out there right now is BlackRock, although Vanguard's catching up pretty fast. You have the exchanges, the New York Stock Exchange, the London Exchange, the CBOE. There's a lot of exchanges. And then government entities, they are kind of quasi-financial intermediaries. You see the Fed loaning money to banks and providing, the lender of last resort. They've become kind of the lender of first resort lately. So the goal of these entities is to provide capital, to essentially let the capital markets function. So they're extremely important. They're massive entities. The players used to be consumers, and governments have excess funds that they provide to corporations. What we've seen recently is corporations and non-US governments have excess funds, and it's consumers and developed governments that need money. So who knows? It keeps shifting. Right now, consumers actually have become excess because of the stimulus package. Suddenly, there's kind of a historically high balance in consumer savings accounts because of the stimulus checks, although it's starting to dissipate here recently. So it moves around, but there was quite a while there where Russia and China were funding the rest of the world because they had all this excess money laying around. That may change. I don't think Russia has a lot of excess money right now, but some of these, have y'all heard of sovereign wealth funds? That term sound familiar? Firms like Norway and Finland, they have these massive multi-billion dollars funds that are just sitting there. So there are governments that have a lot of excess money, and then you have the United States and Japan that are huge deficits. So it keeps changing. So when you take your ecos class, these are really, really important classes. You have to take a macro, M-A-C-R-O. Have y'all taken that yet? Macroeconomics. So that's where you're going to talk about probably what is that most important formula? I keep forgetting. PQ equals VM. Is that how you say it? Y'all remember this formula? It's probably the second most important formula in finance, I mean, in economics. And remember, what does P stand for? Price times what's Q? Quantity or output equals, what's the M? Talking finance, economics. What do you have in your wallet? Money, supply. So what's V? Velocity of money. Y'all see why that's such a critically important formula? So the government grotesquely increased the money supply. What's going to happen when the government, I mean, just, it's off the charts, right? Have y'all looked at the Fed balance sheet? It went from like a little bitty line to this massive line. What happens when the government greatly increases the money supply? One or two things going to happen. The economy is going to grow, or what? A lot of inflation. What happened in the United States? Initially, what happened? Well, the money supply grew, but what did velocity do? It fell dramatically. So nothing happened. They were dramatically doing stuff on this side of the balance sheet, and nothing happened. We had all this money, and a lot of people say, well, I'm just going to sit on the money. And then what suddenly happened in 2022? Velocity money went up. And so what happened? We got inflation, right? Good old Jerome Powell. People are saying, it's money supply. Aren't you worried about that? You're going to have all this inflation. Oh, no, because we don't have any velocity. I'm not worried about it. And then suddenly what happened? People started spending their money. Why did velocity go down? You had a pandemic. You have all this money, right? The government said, you know, I'm an independently wealthy person, and my government sent me a $1,200 check. That's pretty stupid, isn't it? Why is the government sending millionaires $1,200? Is that, do your future generations, do they need a deficit so that they can help me? How did the pandemic hurt me financially? It helped me financially. Why? Because I couldn't go to the restaurants. I couldn't spend any money. So I had $1,200. I just gave it to my charity because it's like, I don't need this money. People are saying, why don't you send it back to government? Well, they've already shown how fiscally irresponsible are. Why would I send the money back to them? They're not going to do anything good with it. So we had this huge supply of money, but we had no place to spend it because everything was shut down. And then suddenly everything opened up, and we had a supply shock. So everybody wanted to spend money, but couldn't spend it because there was no supply of anything. And so we had this massive inflation. So you see the job of the Federal Reserve. They've got to control all of this, but they're not really sure which of these pieces is going to move. And unfortunately for Jerome Powell, it was price that moved and not output. Output couldn't move because we have all these supply disruptions. Any of y'all want to be Fed chairman? Pretty horrible job, isn't it? Really tough. Jerome, I mean, he's smarter than I am. Janet, I always forget Janet's last name. What is Janet's? Janet, I want to say Janet Reno, but that was Clinton's. But anyway, Janet, the previous Fed, smart people, really brilliant people, but with an extremely difficult job. Bernanke, all of them, really tough job because they don't really know what's going to happen over on this side. And the worst problem they have is that when they change this, there's not an immediate reaction. There's like a 6-month, 9-month delay. And so if they overdo it, then they got to fix it. But how long does their fix take? That takes 9 months. And so, and this is both a mathematical equation and it's also a psychological equation. When people are thinking about inflation, guess what happens? You get inflation. All right, because it's psychological. When people are worried about prices rising, what do? You're worried about the price of something going up in 6 months. What do you do today? You run out and buy it real fast. What does that do to this price today? Makes it go up. If you think prices are going to fall in 6 months, what do? You wait. And what happens to prices? They fall. So you can see the Fed And once they know inflation's in people's psyche, they've lost the game. It's just, and there's actually a really good chart. The Economist had this, I think. I can't remember where I saw it, but they did a analysis of at what level of inflation people start Googling the word inflation. And they discovered it's around 4%. When inflation hits 4%, people are starting to Google inflation. And so that's where the Fed has to be careful. When once inflation is 4%, people start worrying about inflation, they start changing their buying behavior. So if I were you, I would know that's probably one of the most important formulas to know. Did y'all cover this? You probably covered it in money and banking. You'll see this in money and banking. Extremely important. I like formulas that are simple, that explain everything. There's a formula that's simple and explains everything. PQ equals VM. It may be different letters because they keep changing the letters on us. We can see. Let's look. I don't want to tell y'all a lie. There it is. Yeah, MV equals PQ. So there it is. Quantity theory of money. What else can you look for? Obviously, Friedman. He's the famous Milton Friedman. I don't know how to spell his name. Milton, Uncle Milton. I would strongly recommend you read Milton Friedman's books. Not that I say I have to agree with him, but because he explains things in very logical, understandable ways. So there's how you spell it, F-R-I-E. So yeah, so don't forget everything you learned in your classes. This stuff is really quite helpful. I like MV equals PQ because I can explain what's going on today in very simple terms. Its velocity is the thing. So you have all these entities going in together. You got these money supplies. You got funds everywhere. You got the governments doing kind of things. So it's a pretty complex formula. You're trying to manage your business. So you need capital. You're short cash. Do you borrow money or use equity? So let's talk about these markets. There are primary markets and there are secondary markets. You may never be in the primary market because the primary market, well, if y'all heard of this term, IPO, initial public offering, that's a primary market. That's when a firm goes out and issues stock where they get the money or they borrow money. It's a primary market. That's a new security, a new bond, a new stock. You're probably not going to participate in that. I mean, you can somewhat participate in IPOs, but it's really a big investor, sophisticated investor market. A season issued is a firm issues equity to issue debt, but they've done it before. So there's just issuing new. So IPO is their first time ever to go out to the market. A secondary issue is this is their second, third, 50th time, whatever. These markets provide cash to the firm. All right. When the firm goes into markets, they get cash. A secondary market provides no cash to the firm. That's where we deal. Because if you buy Apple stock on the stock exchange, how much money goes to Apple? None whatsoever, right? You're buying Apple stock from another Apple investor. So that's just money, but it still provides a signal to Apple management. If people are selling Apple stock and the stock price is falling, that's an indication that the market doesn't like the stock. This part of the market is changing quite dramatically. So primary markets, well, I can't even remember the name of them, all of them. So you got IPOs versus SPACs versus direct issuance. Brian, this would have been a great topic for you to come in. I think you mentioned SPACs in one of yours. So an IPO, that's when you go out and you pay a fortune to an investment banker and they help put all this together. Have y'all heard of SPACs? Y'all know Donald Trump had a SPAC, didn't work out very well, kind of crashed on him, but he had a SPAC. So a SPAC is another way firms are kind of raising money the first time in a way that sounds like it's ripping off the investor, who knows. And in direct listing, there's a really famous direct listing, but I can't remember which firm it was. It might have been Spotify. Let's see. There it is. I think it's Spotify. Um, so what is a direct listing? What Spotify said is, you know what? Forget the investment bankers. We don't need them. We're just going to take our firm and we're going to create shares and we're just going to start trading them so that our employees, our management can essentially start selling their shares. So essentially, you know, HEB could do this, right? HEB could say, hey, all employees, check out clerk, you now have 100 shares of HEB. CEO, you now have 17 million shares of HEB. Wow. CFO, you now have 10 million shares of HEB. We don't know what that means, but that's what you have. How do you figure out how much that HEB is worth? Well, HEB is now publicly listed. They now have shares. You go out there and you say, oh, it's worth 3 cents or it's worth $80. You don't know. And you find that out the next day. You want it to be as high as possible. You probably have an idea and you probably have hired some people to help you with that. But I don't know if Spotify was the first direct listing, but they're the ones who made it really popular. They save a fortune on investment manager fees or on investment banking fees. And it's not, I mean, it's an amazing, we're talking not tens of thousands of dollars or hundred thousands of dollars. We're talking hundreds of millions of dollars that they're savings. It's pretty massive. So it's interesting what's coming up. I don't know if HEB would do a direct listing. That would be kind of interesting. You generally would think of that as being a tech company. So this world itself is changing. It's gotten a lot more interesting. The secondary market hasn't changed too much other than free trading. You can now trade shares for free without any commissions. We have organized exchanges. That's where we deal. In fact, you're not going to really notice this now because you're going to do everything online electronically. It amazes me. I put a trade in for say 100 shares and I click to see, you know, the status of the trade, and it traded like a millionth of a second after I put the trade in there. And it's just like, and it's already done. It was done before I even checked on it. In fact, there are firms out there, and this is just amazing. I don't know what the speed of light is. There it is. I don't know why it's in meters. I want to do it in miles. So 670 million miles per hour. So there are firms who are spending a fortune to be 100 yards closer to the exchange so that their signal to the exchange gets there 100, I don't know what 100,000 yards is in time. We're talking nanoseconds. They can get there a nanosecond earlier than their competition. They're spending a fortune just so they can be 100 yards. I mean, isn't that amazing? Just the speed of light. You wouldn't even think you would notice the speed of light. So that's where these organized exchanges are. They're, you know, it's all about who's the first one to trade. Small investors like us, we're just getting ripped off left and right. You know, why is Robinhood free? Because they're taking your trades and they're selling them to people so that they can rip you off. And that's essentially what they're doing. So you might think it's great. Robinhood's free, and Robinhood's saying, yeah, we're essentially telegraphing what you're doing to competition that's going to get in ahead of you and take advantage of you. Those are organized exchanges. Have y'all been to the New York Stock Exchange? Anybody? Y'all seen the big bull, right? The S&P bull. It's right there around the corner. I recommend it. There's a great place you can take a picture where you have the Wall Street sign and the New York Stock Exchange in the background. It's a great picture. I took a group from my church down there, and they're like, "Why we're down here? We don't want to go here." I was like, it's Wall Street is, and they're like, "We don't care." So we went and visited a church. I was like, yeah, that's kind of boring. Yeah, let's go look at Wall Street. But finance students, you know, it's pretty cool. They've closed it down. It's no longer a street since 9/11, so it's just an open plaza. It's really beautiful down there. I think they really, it's a pretty amazing place. But there's not much going on there. It's still there. They still have the signs. It's still an impressive area, but everything's electronic now. It's more of just kind of a historical artifact. So those are organized exchanges. There's also over-the-counter exchanges. So that's when you're dealing with two really sophisticated investors. Most of the bond market is over the counter. Stocks are organized exchanges. Derivatives tend to be organized exchanges. But things like bonds and swaps, those tend to be over the counter. Now, USAA, when I was there, we did a lot of over the counter trades. So it's pretty common for large sophisticated, USA was buying bonds in $500 million blocks. When you're spending $500 million, you're going to deal a lot differently than when you're spending $5,000. It's a very different world, and bond markets are like that. Now, on the stock side, I was head of equities. On the stock side, even though we're doing, my biggest trade in a day was probably $1 billion. That was pretty cool. I remember the first time I picked up the phone, I did $1 billion. Like, hey, that's pretty cool. And then I'm like, wow, did I do that the right way? That's $1 billion. But $1 billion is nothing on the stock market. I did it through the organized exchange. It's really nothing. $1 billion is peanuts in these markets. They can handle that pretty well. Over-the-counter markets are a little less liquid, and so there's a little more time to do the trades. You have stock markets, bond markets. Private placement is what I'm talking about with over-the-counter. Private placement is when two sophisticated investors deal with each other. It gets rid of a lot of the SEC requirements. It's a much more sophisticated market. That's where you're dealing in $50 million, $100 million, $500 million chunks. When you borrow money, there's different levels of collateral that you can have. You can be unsecured or secured. I learned this early in my career. I called up once. I want to know what IBM's credit rating was. And the lady said, which debt? I said, I mean, IBM. She's like, which debt? IBM has several different debts. Some were junior, some were senior. So I felt like an idiot. I didn't know how to ask the question correctly. So the same company can have different levels of different credit ratings. Now, y'all saw this when you did paper one, I brought in a credit rating. That's probably the most senior debt that they have. That's that credit rating. But take a firm like Delta. Delta was bankrupt for a while there, and they were borrowing money. Would you loan money to someone who's bankrupt? Well, USAA was. Why in the world would USAA loan money to a bankrupt entity? How was Delta doing that? What does Delta have that would be good collateral? What's their best asset, do you think? Their planes. They have planes and a trust. And USA was loaning them money. We were joking with John, who was the investor, say, John, we're joking they're gonna be pulling all these planes and putting them on USA's property, just sitting out there because Delta was in a lot of trouble. But they paid all their debt on time, and if they hadn't, USA would have gotten those planes. And it was priced not dollar for dollar, so we didn't get a $500 million in planes for $500 million in debt. We got $500 million in planes for $400 million in debt. So if they didn't pay us back, we would have more than enough collateral. So if you have collateral, you can borrow money even when you're bankrupt. Now, Delta's come out of it. They restructured and all that. The stockholders, did poorly, but you can exist. So senior debt it can be pretty decently secured if you got some good assets there. Commercial paper is the short-term side. Then firms borrow short-term. When you borrow commercial paper, you have to have lines of credit so that you can pay those borrowers back even when the bond markets are tanking or illiquid. So leases are a form of borrowing. And here's where I think accounting has changed dramatically. Y'all probably know this better than I do. There used to be operating leases and capital leases. My understanding, and we have some accounting majors in here, don't we? My understanding is that operating leases are going away, that there will no longer be operating leases, only capital leases. It makes a big difference. But they're both a sense borrowing money. So let's say you're renting an apartment. Doesn't that feel kind of like debt? You got to pay them $1,000 every month, no matter what. Doesn't that feel like debt? So that's what a lease is. You're renting. There's some leases that at the end of the lease, you have the right to buy the property. And so what the accountants have discovered is, you know what? you're really borrowing money, but you didn't want to put the debt on your balance sheet. So you set it up as a lease so you could just have the rent. And the accountant says, no, 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 you're going to set that up as debt because you're really borrowing money. And so that's a capital lease. But I think the accountants have pretty much said, let's just set up all operating leverage. You know, if you got 10 years where you're going to be paying rent every month for 10 years, let's take the present value of that and say that's debt. So, but I don't know, anybody, y'all don't know. I'm discovering that the accounting classes aren't covering issues. Operating leases. Current FASB. What are the rules? Guidance and examples. So it's out there. There it is, ASC 840. So you need to know that if you're a finance major, there's about 6 FASBs you should know. And I was talking to my risk management class and they hadn't covered any of them in their accounting classes. It's like, okay, you're covering the wrong FASBs. So there's one I would want to know. FASB 115 is one I would absolutely know today. Do y'all know FAS 115? If you're anybody heard of Silicon Valley Bank? That's a FAS 115 disaster. I wouldn't interview at a bank or an insurance company or an investment firm if I did not know FAS 115. So what is it? Well, it's telling you how are you going to report investments, and there's 3 levels. And what are those 3 levels? It's probably in here somewhere, but so you got an asset, you got to put it on your books, and FASB says, well, the valuation depends on what type of asset it is. If it's level 1, I think level 1 is the most liquid, if I remember. It's not even in there, so level 1 assets. So level 1 asset are liquid financial assets where you can find a market price real easy, like stocks, a lot of bonds, treasuries. FASB says put those on your books at market value. That's pretty simple. Level 2 assets are not in here. Level 2 assets, they don't have a regular market price, but you can determine market price based on some model, some pretty well accepted criteria. A lot of bonds are like that, where you can somewhat figure out. Swaps are kind of like that, where you can find those. Private equity, there's models out there to do them. And then level 3 assets are the most difficult ones. Level 3 assets are ones where there's this, I mean, like USA's building. What's the value of that building? Who knows? You could look at the square feet, look at buildings with the same square feet, but that building's not like any other building on the planet. So just who knows what that building would be worth. So that'd be level 3. Another part of, I think this is the real part of FAS 115, which you really saw with Silicon Bank, is held to maturity versus available for sale. Y'all should be studying this stuff undergraduate. This is something, if you're interviewing with a bank or insurance, so what happened with Silicon Valley? Well, they had some bonds and hold for trading or hold to maturity that were falling in price, but no one knew because they weren't marking in the market. Available for sale, you got to mark to market. So this is a huge issue. I would read these. Did y'all cover these in your accounting classes? I haven't had any accounting. I haven't heard anyone say yet that they cover these.
Currently doing.
Are you really? Oh, great, great. As part of your accounting class?
Yeah, he literally just came up with it. He said there was a different group project that we were going to do originally, but then this happened. It's really like.
Oh, it's Silicon Valley. Yeah, yeah. I'm glad you're doing that. This is, a lot of times in accounting, it's like, let's teach what we did last semester, but well, you got some topical stuff coming on here. So, so it's important, these accounting terms. It really affects, firms make decisions based on what they count and say the accounting is, because they're trying to get a certain type of classification. So those are the different markets. So understand your markets, know where the different markets are. But let's turn to the next question of which of those markets should you go to? Should you go to the debt market? Should you go to the stock market? If a firm is trying to fund itself, what's the best way to fund it? And the issue is which of those markets is going to give you the minimum WACC. So let's start off with the obvious, because the obvious is wrong. So we're trying to minimize that. We know the weighted debt times the cost of debt. Well, let's ignore taxes right now. Weight of equity times the cost of equity. And we want to minimize WACC. And we know that the cost of debt is always less than the cost of equity. So it looks really obvious. Minimize WACC by increasing the weight of debt. Wouldn't that do it? If debt is cheaper than equity, the easiest way to reduce your WACC is just increase your weight of debt. That seems obvious on the surface. What's wrong with that equation? When you increase the weight of debt, does the rest of this formula stay the same? You reduce weight of equity. What does increasing the weight of debt do to the other parts of this formula? Why is that wrong? As weight of debt increases, what happens to KE? KE increases because, well, there's only three things in KE. If a firm uses more debt than equity, is that going to make treasury rates go higher? Treasury doesn't care. If a firm decides to use more debt than equity, is that going to make the riskiness of the stock market go up? Stock market doesn't care. That's just one firm. What's the only thing in this formula that's going to change? Beta, because beta rises. Didn't we just do that in your team competition question? Firm with more debt has a higher beta. In fact, it is an exact offset. As increase weight of debt, beta increases, KE increases, such that WACC does not change. Isn't that amazing? There's no impact. And I could prove this to you mathematically, but we're not going to, but you could prove this mathematically. All right, so you have to put this on the exam answer. This is part of the answer. So before taxes, capital structure does not matter. Why not? Because as you increase your weight of debt, you increase your beta, your cost of equity goes up, the two just offset each other, your WACC just stays the same number. All right. That was the first conclusion of these two guys, Miller and Modigliani. His name, it's spelled exactly like it sounds, Modigliani. That was their first, they won the Nobel Prize for this thing. Does that sound like something worth the Nobel Prize? But they said it doesn't matter. Capital structure does not matter. Before taxes. Now, where do you go in the world where there's no taxes? Cayman Islands maybe, or somewhere, I don't know. After taxes, it matters, because what is the WACC function? There is taxes in there, isn't there? After tax, WACC falls as increased WD because why? Interest is tax deductible. So after tax, it does matter. After tax, more debt is good. Why? Because the US taxpayer is paying part of your cost of debt. And you want to take advantage of that. But this is up to a point. Up to what point? Well, at some point, too much debt, too high a WD increases bankruptcy risk and cost. In that case, you've gone too far. Water bankruptcy costs, where your cost of debt is going to start going up. And not only that, if your firm is at the risk of bankruptcy, what are your best employees going to do? How many of y'all are interviewing with Sears and Roebuck for a job? Anybody? Any of y'all going to go to Bed Bath and Beyond and apply for a job? Why aren't you applying? You're the smartest students at UTSA, right? You're honest students. Why aren't y'all going to those firms? Because they're going to go out of business, right? You can go to the best firms. So there's a bankruptcy cost that they lose their best employees, they lose customers, because who wants to deal with a firm that may be out of business in a few years, right? F5. If F5 is your providing security for your cloud and they may go out of business, you're going to switch to another entity. All right, so that in a nutshell is the answer to your question. So let's look at the graph. We got 3 minutes. Don't leave left. Don't leave yet. So what you're going to notice is the WACC declines for a while. And why is it declining as you increase your weighted debt? It's declining only for one reason, and that's the tax shield of debt. It's the tax for tax reasons. At some point, the WACC starts increasing. Why is that? Because you're borrowing too much money, becoming risky for bankruptcy. So you still have the tax advantage, but it's more than offset by those bankruptcy costs. So where would you want to be in this chart? You want to be right here at minimum WACC. Okay. Up here, so over here, it's the cost of capital. Up here, they don't have the cost of capital. They have the value of the firm. Where do you want to be on the value of the firm? Where the value is maximum. Where's the value maximum? Where cost of capital is its minimum. So there's two ways they do these charts. I don't know which chart I'm going to give you on the exam, but if the line's going up, then you have value of the firm over here. If the line is coming down, then you have cost of capital over there. All right. So the key is we're trying to find that optimal capital structure so we maximize the tax shield without getting too much bankruptcy costs. And where is that point? We'll have to figure that out. All right, so we'll finish this up. Now you don't just have two answers to the question out there. Now you have three, because I just added another one. That's probably why I'm confusing students. I just keep giving you this. But we'll work on it this next class and get it together. All right. I think I'm going to do a team competition on this one because this is such a bad question on the exam. So maybe next Wednesday we'll do it and we'll see which team does better on it.